Chinese economy has slipped into a deep slump.
China is announcing stimulus plans.
They are going to really push out a bazooka to get stock prices up.
This is the broadest push so far year to date. You can call it a bazooka or not,
but nothing seems to be working.
What's up, guys? You're not going to believe what just happened. Despite China being on the brink of an economic collapse with a multi-trillion-dollar underwater housing market, threats of being delisted from the U.S. stock exchange, in weakening demand in the last 30 days, they've experienced one of the strongest stock market rallies in almost a decade, all thanks to a new strategy, the economic reset. That's right. Apparently, money can solve all of your problems. Even though some analysts believe this only delays the inevitable, China's latest stimulus package is about to impact every financial market around the world, from real estate to lending to interest rates to even the value of the US dollar. To break this down, let's discuss exactly what happened through the new economic reset that's resulted in a 20% stock market rally, whether or not this massive stimulus is actually sustainable, and then finally what you could do about this to come out ahead. Background. Up until recently, China's been on an unstoppable trajectory. For the last 30 years, they've been at the forefront of production, international investment, and rapid productivity, all because of an exchange that occurred back in 1979, which gave China diplomatic relations with the United States and, by extension, the rest of the world. All of a sudden, China shared a common objective with the global economy, and as a result, money poured in. Countries from around the world invested in Chinese infrastructure, took advantage of low-cost labor, and helped bring much-needed funding to areas that were previously closed off. At this time, growth was so impressive that in 2001, China became a member of the World Trade Organization as a way to further strengthen ties with the United States. But it didn't go exactly as planned for the United States. It quickly became apparent that demand for low-cost Chinese goods was increasing faster than expected. More and more products were being outsourced elsewhere, and corporations moved 6 million jobs overseas to allow for higher profits. Even though this did bring down the cost of everyday items that a lot of us still use to this day, for China, the benefits were monumental. With all the increased worldwide trade and foreign investment, 400 million people were lifted from poverty. In addition, their economy is now more than 11 times larger today than it was in 2001. They became the world's largest exporting nation in 2009, and they were even touted as the world's economic miracle while growing at a faster pace than any other nation. However, not everything appeared exactly as it was on the surface. The more China grew, the more powerful they became in relation to every other nation, the more leverage they had to maintain tight control over their businesses, and the more they could regulate as they deemed necessary. As a result of all that, the more difficult they've been to join forces with. In fact, members of the World Trade Organization allege that China's been providing illegal state subsidies to businesses who export their products, discriminating against companies who don't buy from Chinese manufacturers, and controlling supply chains through taxing raw materials. Even worse, it's said that they've been purposely devaluing their own currency by as much as 40% as an incentive for other countries to buy their goods at a discount, leading, of course, to fake economic growth that was largely unsustainable, as we've recently begun to see. So in terms of the three major roadblocks for China and how they're now dealing with it, let's begin with the first real estate bubble. Up until recently, China experienced what many would call a real estate property bubble. Citizens preferred to put their money in housing as a safety net, causing real estate prices to increase double digits year after year. In fact, China was building 5 times as many homes as America and Europe combined, and supply was still so limited that they used a lottery system to allocate them, some with odds as low as 1 in 60. This led to 70% of the country's wealth being tied up in the real estate market, which is more than twice as high as it is here in the United States. At that point, property values were rising so quickly that developers would pre-sell units and buyers would begin making payments on something before it even existed, with the expectation that once it's done, it's going to be worth a lot more. The market just kept moving higher, and it didn't matter how much it cost. Some buyers spent as much as 23 times their annual income to say they owned a property, oftentimes with the mortgage making up more than half of their gross take-home pay. China's real estate market was growing so quickly that prices increased 700% from 2001 to 2017. In an effort to curb some of this appreciation, the government stepped in with imposed regulations on who could purchase a house and said that homes should be for living, not for speculation. But it was too little, too late. With their economy now beginning to slow down, property developers had a harder time raising money in order to stay afloat. They couldn't afford to finish their pre-construction units, and even though this originally started with Evergrande, within 4 weeks, more than 320 projects in about 100 cities were facing protests, roiling markets and forcing authorities to corral banks and developers to diffuse the unrest. This led to Evergrande, their second largest property developer, filing for bankruptcy in mid-2023 after owing more than $300 billion to its investors. An estimated 233 other property developers filed for bankruptcy shortly afterward. In response to this, China began lowering interest rates as a way to help spark some more economic growth. Youth unemployment. Unemployment in China began to rise significantly in 1998 when the country expanded its higher education system. This expansion provided much-needed funding to build schools, hire professors, and offer education to students who couldn't otherwise afford it. The goal was to develop a knowledge-based economy, satisfy the demand for highly educated workers, and grow the economy to compete globally. As a result, Chinese universities accepted approximately 1.59 million students in 1999, an increase of more than 47% from the previous year. Higher education became almost like mass education, accessible to anyone interested, even those in rural, low-income areas. However, higher education expanded faster than market demand, creating more college graduates than available jobs. Consequently, youth unemployment increased. Currently, the jobless rate for 16 to 24-year-olds is 18.8%, steadily rising since surveys began in 2018. Unemployment has gotten so severe that lottery sales have increased by more than 50%, as many young people view hitting the jackpot as their only chance at financial freedom. Additionally, companies are reluctant to hire recent college graduates due to the cost and legal difficulties of letting employees go if the economy remains stagnant. For instance, if someone works for 2 years, companies must give 30 days notice plus 2 months' salary as severance. In 2023, youth unemployment became so dire that the government stopped publishing data for several months, resuming only after altering its methodology. Deflation. Another pressing issue is deflation, the opposite of inflation, where prices fall instead of rising. While this may sound positive, it's not. Lower prices indicate less demand, and as money becomes more valuable over time, consumers and businesses hold on to it instead of spending. This causes prices to fall further, companies to scale back, and the economy to weaken in a repeating cycle. In China's case, after 3 years of COVID lockdowns, consumers remain reluctant to spend. Recent Consumer Price Index, CPI data, shows only a 4% increase year over year. Even though household income growth is outpacing spending, with disposable income per capita rising 5.4% in the first half of the year, economic uncertainty looms due to falling real estate prices, bank runs, and high unemployment. Stimulus measures. To address the slowing economy, China has introduced an economic reset, what some call the Bazooka stimulus. Key stimulus actions. 1. Bank funding proposals. The People's Bank of China recently approved 2 proposals injecting $112 billion into the stock market. 2. Lower interest rates. Borrowing money has been made cheaper, and mortgage rates have been reduced for homeowners, benefiting 50 million households. 3rd, reserve requirement cuts. Banks' reserve requirements were lowered, freeing up $140 billion for lending. Additionally, $28 billion has been allocated for local government investment projects, and down payments for second homes, often purchased as investments, were cut from 25% to 15% of the apartment's value. However, this contradicts previous government statements that second homes are for living, not for speculation. Additional measures, sovereign bonds. Beijing is rumored to release $284 billion in sovereign bonds later this year to pay down local government debt and bolster social safety nets. Future stimulus packages. Government officials are pushing for a larger stimulus package, potentially as high as $1.4 trillion, to prevent the economy from collapsing. Optimism and concerns. From an investment standpoint, these measures have sparked optimism, with the stock market rising over 20% in the last month. However, much of this rally is driven by the expectation of future stimulus rather than existing policies. Some actions, like reducing bank reserve requirements, could pose risks. If a liquidity crisis occurs and customers demand their money simultaneously, banks may face significant challenges. While the central bank may introduce another reserve cut to double the money available for lending, this approach could be seen as a temporary fix rather than a long-term solution. It's reminiscent of printing money to delay economic slowdown, a cycle that eventually repeats. China's economic challenges, youth unemployment, deflation, and slowing growth, are deeply rooted. While stimulus measures provide short-term relief, they raise questions about sustainability. The ongoing optimism in the stock market is largely based on promises that may not materialize. For now, it remains uncertain whether these policies will lead to long-term growth or merely delay the inevitable. Let me know what you think in the comments section below. As always, don't forget to like, subscribe, and stay tuned for more updates. Until next time.